Module 2, Fundamentals of Accounting. Lesson 1, The Accounting Equation, the Foundation of Accounting. The accounting equation assets equals liabilities plus equity. This equation is the core principle of accounting, showing that everything a business owns, assets, is financed either by borrowing money, liabilities, or through the owner's investment and retained earnings, equity. Assets, what the business owns or controls that has future economic value, are grouped as current, short-term, and non-current, long-term. Under the accrual method, assets include amounts earned but not yet received, and expenses paid in advance. Current assets expected to be used or converted to cash within 1 year. Cash, money in hand or in the bank. Accounts receivable, money owed by customers for credit sales. Notes receivable, short-term, formal written promises from customers to pay within a year. Inventory, goods held for sale. Retailers or raw materials, manufacturers. Prepaid expenses, payments made in advance for services, for example, prepaid rent, insurance. Supplies, office or business supplies not yet used. Example, you sold services worth 20,000 pesos on credit. You recognize the income and create an accounts receivable entry even though the client hasn't paid yet. Non-current assets are used in business operations for more than 1 year. Property, plant, and equipment, or PPE, include long-term assets like land, buildings, vehicles, and machinery. Accumulated depreciation is the total depreciation charged against fixed assets over time and is considered a contra asset. Long-term investments are those the business doesn't plan to convert to cash within a year. Intangible assets are non-physical assets like patents, copyrights, or goodwill. Example, a business buys a delivery van for 800,000 pesos. It's recorded as a vehicle, asset, and depreciated over its useful life. Liabilities, what the business owes to others, are also grouped as current and non-current. Under the accrual method, this includes expenses already incurred but not yet paid, called accrued expenses. Current liabilities due within 1 year. Accounts payable, amount owed to suppliers for purchases made on credit. Notes payable, short-term, formal written obligations due within a year. Accrued expenses, expenses incurred but not yet paid, for example, salaries, utilities. Unearned revenue, payments received in advance for services not yet performed. Taxes payable, amounts owed to the government, for example, VAT, income tax withholding. Example, you received 15,000 pesos advance payment for a 3-month service contract. You record it as unearned revenue, not income, until the service is delivered. Non-current liabilities, obligations due beyond 1 year. Notes payable, long-term, loans or debts due after more than 1 year. Loan payable, formal bank loans with long-term repayment. Bonds payable, debt instruments issued to investors, usually for corporations. Example, you take out a 500,000 peso bank loan payable over 5 years. You split the amount into current and non-current portions depending on the portion due in the next 12 months. Equity equals the owner's share. This is the value left for the owner after subtracting liabilities from assets. Examples of equity accounts: owner's investment, owner's capital, money the owner puts into the business, owner's draw, owner's drawings, money the owner takes out for personal use, business profit, retained earnings, profits that stay in the business. End of Module 2 Lesson 1.